All right, so the live session is what, June 2nd, 2015. We're in the midst of Greece resurfacing as being a hot kind of button tape bomb. This week they have Friday is going to be a deadline. It keeps coming back and forth across the wire that it's a problem. They can't reach an agreement. They do reach an agreement. No, they haven't. And the markets have kind of ebbed and flowed with it. Latest thing has kind of dispelled a lot of the weakness as we go on live here, and they've rallied and gotten strong again, certainly within reach of all-time highs. We've had good price action over the last, I would say, 5 or 6, 7 sessions, where we've getting more. Anytime you get a two-sided market, you get good price action, you get more volume. If it grinds up, that's when you get the people complaining about low volume. It's not low volume they're complaining about, it's lack of movement. Lack of movement, low volume goes together, lack of opportunity. It's not because people are leaving the business or the industry stinks. I've been doing this for 15 years, 5 years on the floor, 15 in front of a screen. It's cyclical, and sometimes it's cyclical. 2 weeks low volume, 3 weeks of great volume, and back and forth they go. It technically or typically doesn't last years and years and years, or months and months and months rather, of low volume. It could go on for a little while. There's always something moving and always something active. Certainly has a lot to do with geopolitical events, political events, fundamental analysis, and now we've got the Fed. So don't worry when volume gets a little light, because then it gets back to normal or better when we get more of a two-sided trade. That's what we want. That's what we've gotten over the last week, week and a half. Greece has added to that as we get into later this month, the FOMC meeting. Will they or will they not raise rates? Probably not is the bet. You could see that in equity markets. However, they left the door slightly open at the April meeting that they could do it in June, or certainly didn't say they would not do it. But that's kind of what's going on right now on a macro scale. Is it important? Absolutely. Even in a micro kind of situation where, there was a chance to get long earlier, right before the room closed, as it started to walk up to 8, 9 even, and then that story came out and it softened us up. It softened European equities into their close, and it softened us up down to the open. Couldn't go through, and then what did it do? Rallied the 6, 7 points through 09 like it would have done 4, 5, 10 bars prior, 20 minutes prior, but that story put a little loop in the chart, dragged us down. So it's really important to follow how these stories are affecting prices, because it could turn a great idea into a losing trade, being unaware of it. So today we're going to go over the PnF again and again and again. I've added a couple things to it than from my previous discussions about it, with comparing a test of a price to a rotation of a price. But PnF quite simply stands for point and figure. That's what the acronym of it is on market deltas charts and such. But this isn't a point and figure class. To be quite honest with you, I'm not a point and figure expert. It's a way to look at rotations and the flow of a market. You have different periodicities that you could use. We're going to go over a couple of them, talk to you why the PnF, in my opinion, is the best, and take it one step at a time like that. So here, what to expect from today: time periodicity versus a PnF. What does rotation means? Rotations versus tests, and then consolidation or chop as near term or medium term, even support and resistance. I think you guys will like that. I briefly touched on it in the room yesterday. So rotations. I don't know what happened with this time versus PnF slide. I don't know if it went away or it's next, but we'll flip these two and just talk about rotations. I don't know. I can't take the suspense. So let's just go to rotations. Or, I'm sorry, time versus PnF real quick. Time when I started, this is the only periodicity we used. 5-minute, 15-minute, 30, 60, and daily were the common ones, most popular ones. Most of us used 5 to 2-minute bars and looked at 15 and 30 for a little better perspective. We glanced at dailies, didn't really use 60, but these are the most common periodicities for time. Range, I just put 1, 4-tick range. What does that mean? Every bar is going to be 4 ticks. Once it's a 4-tick range, another bar opens up. What's important to know about bars or periodicities? What is going to be the qualifier for a new bar? What's a new qualifier for a 5-minute bar? Every 5 minutes, and so on. Qualifier for a range bar is every 4 ticks. So now we walk in. I'm not going to cover all periodicities because it'll be boring. PnF 4, 6, 8, 10. I use a lot of the 4. Other markets have different periodicities that show better rotation. I'll show you with better illustration how another PnF bar becomes it gets qualified and starts to show those rotations. I flipped these charts, so I got to go back one slide to rotations. I constantly say this. It's in the setup videos, I think. Constantly say it in the trading room, but I gotta keep hammering away at it. This is how a chart should look to you. Forget about the numbers in it for now. Forget about a candlestick or a bar. This is how a chart should look, whatever periodicity you're using. If you're using a 30-minute, it should go up and down and up and down. That's what you should see inside any kind of chart. Your eyes have to fixate and follow it as if it was a snake. Swing highs, swing lows, consolidation tops, bottoms, all that stuff. If it's not following around like that, then you're going to have trouble trading something that you have trouble following. If I was able to tilt the bars, this is what they would look like. So instead of being straight up and down, this is up the mountain. This is down the mountain. That's a down bar, right? So if that's an up bar and this down bar totally retraces the up bar, it's a long up-down bar setup, like you see in one of the videos. So what happens is the next bar is a little shorter up. The next bar continues to move lower. But if you were able to tilt the bars or the footprints, this is how you tilt them. Going up the mountain in here, coming back down all the way. Chances are it isn't going to get all the way back up. It's too tired and it runs down. That's why the long up down is a high probability setup or transitional moment. There's reasons why we went over and over it. Longs tend to get stuck in it. More longs that are stuck, more chance that we're going south. But if you could put those arrows constantly in the footprint and just imagine the footprint bars being tilted like this, it's going to give you a much better foundational way to, follow it, track it. We went over this. Now, here's a good example. What makes a 4 PnF populate into another bar? If it's a 4, it's got to start with either an up or down bar. For this example, it's an up bar. So each little line that I'm popping in here is a different price level, right? With a certain amount of contracts trading on the bid, certain amount on the offer, all the way up. So it's tracking each, forget about the numbers that are in here. It's tracking each price level. Right now, it's tracking and saying, okay, that's the high of the move. No, that's the high of the move. No, that's the high of the move. Market backs off a couple ticks, comes back. Well, that's the high of the move. And all of a sudden, get rid of that. All of a sudden, the market backs off because it's a 4 PnF, 4 ticks, which means follow my cursor. This is the high of the move. If it comes down 1, 2, 3, 4, another bar is going to form. That's going to be a down bar. And that's where it would start. And then guess what? That's going to start keeping track of the low of the move. That's the low of the move. Then it goes away. That's the low of the move. That's the low of the move. Then it might go up a couple. Goes down. Still the low of the move. Oop, that's the new low of the move. and all of a sudden maybe it comes up. Nope, that's a low of the move. And then when it finally comes up enough, 4 ticks off the low, 1, 2, 3, 4, this bar comes in. So if we were to take those arrows, I'll have to draw them in. This is obviously the up bar. This became the down bar. This will start to populate into the next up bar. That has to be, let me go back to it. That has to be just 101. It has to be very foundational. If it's not, then you're not going to have a lot of luck trading something you're having trouble following and tracking. Now, if it was a 6 PnF, same thing, only it has to retrace 6 ticks off the high to pop a new bar. It has to track 6 ticks off the low to pop a new bar, and so on. That's why if you had a higher number PnF, you're going to get less bars. If I put in a 50 PnF, you might have a couple bars for the whole day. The more a market moves, like oil, the higher the PnF, like the DAX, like oil, like gold, even like the euro. The slower a market moves, like the 10-year note, the 30-year bond at times, the lower this PnF. For me, and this is just me personally, I could assume to kind of know what the 6 and 8 PnF look like in the 4, but I have trouble seeing the 4 in the 6. I'd rather have, I'm better maybe than some at navigating through the noise. All right. Rotations versus tests. Now that other stuff, it might be academic or elementary to some. For others, it's good review. For others, it's brand new. Either way, it's worth going over because I just, people don't get it as much as they should. So it's worth making sure everybody is good with it. Now, rotations versus tests. This has everything to do with like in the moment, right? It's like time has a lot to do with the difference between a test of a price level and rotational tests to a price level. So I call this a sketch pad because I'm going to sketch on it. Rotations would be real simple, where this is like one scenario, moment in time inside this box. And the market is this blue line, and it walks itself into this box. And inside this box has a price level that it's going to either look to test or it becomes a price that it's tested. A lot of people mistake like every target, every price is already predetermined. Sometimes it gets determined in real-time analysis. That aside, if in this one story, in this one chapter, the market is doing this, that's 1, 2, 3, 4 rotations, but one test to this price level inside this rectangle. Now, the market starts to move up. 10 minutes later, half hour later, 2 hours later, it comes back to test that level. That's the second test. And this could be 2 rotations. 1 rotation there, 2 rotations there. What do you think is most likely to happen with more tests and rotations to a specific level? It's got a better chance of going through that level. In this case, down. Do I want to be long? Do you want to be long this moment right in here in this triangle? No, for 2 reasons. It's the third rotation of a second test to this particular price level. Forget why it's a price level. Forget why it's a target. Forget why it might be support. You're starting to really build a good case with clues that this market is going to slide south. If it doesn't, you're building a good case for why it's going to take out some upside price targets. It's going to give you a clue either way. It's more of a probability that it's going to go lower. Now, don't try to figure out the stats of how many rotations of how many tests does the market go through a specific price level. You'll go crazy and it won't help you. The recognition of, hey, this is the second test here. It rotated 4 times and they couldn't get this SOB to go through. Now it's coming back down again. The ice is cracking. This is stuff that subconsciously you'll know and might not even know, as you get good at it. I subconsciously know this without even knowing it's a second test. It's just you train yourself to know we've been down here before. So the distance between this box, the second test, and this box, would kind of make it be a little bit more clear as to why it's a test. There was time in between, here. It came back down. Again, don't ask the questions of how much time creates the separation between test 1 and test 2, because you're trying to blacken it up too much. And you're trying to quantify it too much. You're trying to be an engineer instead of a trader. So that's the difference, the main difference between rotations versus tests. Both are important. I'd rather be short the third rotation, the second rotation even of a second test, than the second rotation of a first test. It's important to know, and if you can't follow it, you can't trade it. That's why quoting is important. It's not going to make you $1 million, but it's a big step. So let's go to consolidation or chop, range, whatever you want to call it, as support resistance. Why? Why would it be near-term support resistance? Let me qualify. This is not the alert levels I talk about. This is not an explanation or a definition of how I get them. This is another way to find better longer-term trades and then try to qualify it with actually having trading skill. One thing I thought about over my vacation was always trying to help marry longer-term traders to shorter to the skill set. One thing I always think about is how to always get better at helping people utilize what I teach into any time frame and style and market. Those overlaps are really important. Because first of all, I can't just say it once, expect people to understand it, but it's the right things to say that overlap of style and personality and time frame to show you why this isn't just for short-term traders. It might look like that on the surface, but it's not. So what is that overlap? Well, to me, I don't think there's a lot, as I should say this, I don't think there's that much skill. I'm going to get into the why it works in a moment. I don't think there's as much skill as an investor as there is in a trader. I consider someone looking for 5 points or 3 or 5 day trades, 6 month trades, as someone who's going to, in my opinion, have less skill, less down and dirty ground skill than someone who is on the ground and is able to execute sharper, right, more definitive. And I'm trying to get that bleed over, right, that overlap of both time frames. To me, if you have a line in the sand, this blue line in here, and the market comes down and you say, I'm going to buy this support and I'm going to risk 3 points. I'm willing to take a 3-point loser to make 5 points. There's nothing wrong with that. I mean, that's great. 5 points is better than 3 points. Your risk reward is in decent shape. If you were to say, I'm going to look to make 10 points and only risk 3, I'd say you're trying to bench press 500 pounds and you never lifted a weight, right? It's kind of a too upside down risk reward model. But 3 to 5 like that, that's not bad. 1/2 to 1, that's not bad. So you say, I'm going to buy it if it gets down to my area, and I'm going to sit with it. And I'm either going to lose 3 points or make 5 points. If you got good areas, right, could work, but you better take into consideration emotional capital. You better take in consideration that the market's going to get close to that sometimes and come back all the way down. It's going to get close to that, not take you out, come back up. Oh, it's a winner. No, it's not. It's a loser. No, it's not. It's a winner. Ah, it's a loser. I knew it. You better get used to that. It's going to happen also. That's going to be part of that strategy. The longer you hold on to an investment that's moving, the more you're on that roller coaster with it. If you were long real estate in 05, man, you seen it blast up in 06. If you kept it in 07, 08, 09, 10, you seen it come off. Then it came back. So you held that investment longer, you were on more of a roller coaster with it. The housing market typically throughout history doesn't move as much as it did from 04 to 10 in those years. Our markets do. They move like that sometimes every day. It's bullish, it's bearish, oh no, right? I mean, you could create moments like that almost every day in any market, including the slow ones. So the longer you're in a trade, you could almost assume the more emotional capital you're going to spend, period. So you better make more. If someone says, I like 10-point winners, God bless you. You better get them with how long you hold on to that damn thing for. So that's important. You still got to pick good areas. And I don't think there's as much skill and talent in trading this way. I think that there could be opportunity and money to be made. And I do think that people trade this way and make money if their areas are good. Why not create skill to say, not trade it now? To me, and by the way, I don't consider this trading. I consider it more, I don't know, I consider it more investing, even though it might only take an hour for this whole thing to develop. You know, the less ideas that you have and have to implement, it's just the less skill that you have. This works for a lot of people, don't get me wrong, but there's always a way to make whatever strategy you want to implement better. So if you're a -3+5 type of guy and you want to trade areas, great. How do you make it better? Everyone could get better at everything that we do. You might need to just get better to make this a working strategy. You might like this strategy and you say, yeah, but I'm not having a success with it. That could happen too. How do you get better? Well, I got to find better areas. BS, you don't have to find better areas. You got to learn to trade the areas better. You got to learn to disqualify and qualify the areas better. That's what you have to learn to do, or else you're not going to get better. You're not going to find better areas. That isn't in and of itself going to work for you, because you might find better areas. In those days, it's more volatile. Those areas are getting breached and you're not able to create skill. Everybody is trying to find ways to make money without learning a skill. You guys aren't. You guys have learned the skill and are learning the skill, and it never stops. So I could say that to you. So let me get back to this. So wouldn't it be better not to scalp the first portion of the position? I'm not trying to get into that. I think that would be better, to be able to take a small profit as it gets up to your +5 and maybe trail a stop. There's all different kinds of ways you could trade this better. But then you're going to try to be too scientific with it. When do I know to put a trailing stop? Do I put it break even +1? Where would I put? I got news for you. As soon as you start playing with trailing stops, you're going to get triggered. You're going to get hit. Couple things is to make this better is to learn the rotational value of getting on the ground better to qualify and disqualify the trades, and I'll show you that in a moment. When you have an area, for two reasons. Sometimes range consolidation, I don't use it to create my alert levels, but you get range consolidation to usually get enough people that have opened or closed positions. That's the true definition of my levels. It's also part the definition of some range consolidation that you see. That could also be a little longer term support resistance, and I'm going to show you on a real chart and how you could implement this -3 to +5 type of strategy. Not those exact risk reward parameters, but just a little bit more, just a little bit less tempo to slow things down for you when you look to open a position and then start to implement some of the executional skills that this course gives you and some of the things you look at to buy it or sell it, because you've taken the hardest part of trading, and that is, should I buy it or should I sell it? If you get good at that, that's where confidence comes from. Then the skill of executing it turns it into success. But if you're not good at executing, you could be bullish in a bull market and lose money. So let me get rid of these drawings here. Going back to why is chop support or resistance? If you could start assuming that when you get decent chop on a longer term chart, when you could start assuming there was enough people, this is where a profile would come in and show you a bell curve of volume that comes out. But you got to know how to trade it. You got to know what to do with it. And you want to look for less confirmation. So the market leaves that area of consolidation. Typically, it's going to come, re-chop there, and leave and rally back up again. And these are value players. These are guys looking to, buy previous chop, sell previous. If it was that easy, a lot of people would do it. It's not super easy, but you could take a lot of thought out of it, and you could not put your sell stops. Let's say you got long at this line in the middle of that chop over there. You don't put your sell stop at the bottom of that consolidation. You put it at the bottom of that consolidation. Now you got to know how far it is from your entry to where about you would get out. If that's 3 points, that in and of itself can't set the reward, because that could put the reward way up here, way above some targets in between where you got in and where you want to get out. Now you're going to fight with more emotional capital. And if it does get up here, it's going to take longer. Remember, longer you're going to trade, the more motion you're going to have. So you can't just use how much risk there is, but you do know, and it starts getting you to think of where you're going to get out before you get in. Most people stink at that, especially for losers, because the mind doesn't want to consider you could be wrong. As soon as the mind starts considering it could be wrong, it does what? Talks you out of getting into a trade. So you could say, hey, I want to take the dead middle of this consolidation, buy it, risk 3 points, and get out below this previous top, a few ticks. That's my +5. Does that risk reward make sense? Yes. You can implement a strategy like that, as long as your recognition of what consolidation is good and what is just noise. And that's a strategy, not that I'm trying to advocate or trying to create, but to help people to start to think and create better levels for themselves to say, I'm going to be bullish no matter what. Now it's just a matter of executing with the skills I'm developing. Because now if you take better entries at better levels and willing to risk a little more than I do, is when you're going to find you're on the team for being on the right side of the market. The upside's the right side, and not only did you call it, not only did it work, but you're on the team. You're going to be an investor / swing trader / scalper all in one. And you won't be a scalper, but you'll have the tools and the skills of one already. You can implement the skills of a scalper to start backing into a longer term, even if it's just a few hours. That's longer term to me, still relatively short term intraday type trader. When you could bleed those skill sets into creating an opinion with great executional skills, is when you put yourself on the team and your predictive skills jump, your confidence jumps, and you're able to manage risk, not as quick as I do, but as healthy as I do, because you're not wrong for long, and you know where you're getting out before you get in. but you got to get confident at picking good areas. I tell people to try to find out how I get my alert levels all the time, but I'm not going to just say here they are yet. Might do it at some point in the future. I don't want to spend a lot of time answering people's questions either. Is that how you do it? Is that how you do it? Is that how you do it? But look at, I'm going to show you this on a live chart or a real chart, previous consolidation and how to separate the ones that are better than others. All right. Let's go to a live chart. You can see what this market did right before I came on. Finally blasted through 09 and then used 09, 10 as support. Went up to 11.5 to the tick, came down, blasted through that, went to a level of 1450 I had, 15 I had, came off of that, and it's just been slow. It looked like choppy over the last 30 or 40 minutes. Playing through yesterday's close is now support in the bottom of consolidation. Let's go to a 30-minute chart, and let's look at that as consolidation recognition. Let me open it up this way. So each candle in here is what, 30 minutes. Every 30 minutes, new bar opens up. To me, the market doesn't care that much about time. It cares about where it stopped moving. That's important. Where did he go last? When you're following something, it's important to follow their footsteps, right? Those would be pretty good clues. That's why these are called footprints. When you put a good periodicity for rotation, they become even more powerful in following a market. Can't predict it unless you can follow it. 30 minutes don't show you great rotations. Do you think the market always cares up? Bottom of the hour. There's sometimes buy and sell programs that come in on the hour, but they're not going to allow you to predict that. You know, it's not going to happen every half hour, and it barely ever does. New bar, and the last one was red, must mean we're going down. Too arbitrary to me to make sense. It's got to be those wow moments, like we're going down because I could see longs being stuck, and this is where they're going to cry uncle. Now that makes a little bit more sense, predicting why it's going to go down with rotation. So now let's just look at a way to find consolidation. If you look at, and I want the team rooms to morph into doing this and highlighting where you think, not where you should buy it. And I got to keep reiterating some of the rules, ground rules of these team rooms about not calling out trades, and I hope nobody's doing that. Not saying I'm going to buy it here or sell it here. Should I buy it here? Those are questions that aren't talked about in a prop firm. If people are asking that, you got to stop it, because you wouldn't be doing that if you were hired and put in a prop firm. You wouldn't say, as you're in a row of traders, you wouldn't say, hey, should I buy it here at 13 even, Jim? I never heard anybody ever ask that question in a prop firm setting. Never. I never heard someone say, hey, I'm long. By the way, I'm long. I knew he was long when I'd hear him swear when the market went down. Market went down, he'd swear. I said, oh, he's probably long, to myself. So I hope that's not going on. We're going to keep circling back to that, but that can't go on. You can't do that. And if you do, you're not replicating a prop firm environment. Just you're not. But you can't say, hey, there's some consolidation around. Let's back this up. There's some consolidation in a 30-minute candlestick between 15 and 11, 4-point range, and most of it came out after 7. To me, it's more important consolidation when it comes out in the ES after about 7 Central, because the bond market opens at 7:20 Central. It's when most U.S. traders are getting to their desks around 7 Central. Not just the 8:30 Central cash open, 7:20 the U.S. bonds open up. It's essentially when the U.S. business day opens, 7:20 Central. That's when you'll see volumes pick up in markets globally. And then again, another big uptick at the 8:30 Central Cash Open. So when you get this market to chop around, sometimes a POC will be sent down there, sometimes a bell curve will kick out on a volume profile or a TPO. You could say somewhere in here could be some support. Now, of course, I used this one because it worked. But you see it comes down into here, plays around for a couple hours, overnight, and then rallies. This was in the last week. Rallies out of it. First test to this level. Remember, this isn't the first test. This is worth going over again. This is what's creating potentially a level. This is the first test. This is the second test. Now, you can't ignore the fact that it tested it overnight, because that really happened. You can't say, oh, it happened overnight, so it probably, let's just discount it. That really happened. So it comes right back up, tests 15 area again, and rotates back down. Old support became new resistance. If in this trade, and let's just take this trade as simple as we can, we bought the middle of this, we were not going to risk below here, we were going to risk below there. So you got to be comfortable with that risk, and you got to make sure the reward, which without seeing this, my reward would be underneath those swing highs. And if I'm looking for 5 or 6 points, I'm not just putting it 2 ticks underneath the target and putting it aggressively above that. Probably at least 6 ticks. Don't get too scientific on me, though. The whole point is the bigger the winner, the more you could cheat underneath your target. So if you're looking for a 6-point winner because your target is 7 points away, that's good. Cheating 4 ticks below your target is nothing when you're talking about 6 or 7 point winners. Now, if I'm looking for a 6-tick winner and I cheat 4 ticks underneath it, now come on, and that's you're trying to you're cheating by 2/3. So it's a percentage. When I say targets, where do you think this market has an upside target or potential overhead resistance? Just looking at swing highs, overnight highs, it's up there. You play it below there to try to get out there. And mind you, that's about an 8-point winner to risk 4. 2 to 1 is even hard to get. I'm not trying to show you guys a new strategy. I'm showing you how to try to create better levels and then use the skill that you have to either have or learn to execute better within this chop if you were to execute, to pull up the risk, to manage the trade. Remember, these are half-hour bars. So if you bought it at, let's say, 13, 14, you're in this trade for 2 hours. Remember that the longer you're in a trade, the more it takes to have it be profitable, the more gut-wrenching and emotional you're going to be. I don't care if you're buying a house from 2005 to 2011 or an S&P future risking 4 ticks to make 8 points. 2 hours you're in the trade. Now this is overnight, mind you. I don't want to be the one that shows the best range consolidation for you guys. I want you guys to be able to pull them out, to find a choppiness, even in an overnight session is fine if you see them working. I'd give more validity to like a decent day that had some chop in it. Meaning we had decent price action. It wasn't choppy because it was slow, but there was a level that the market fought over. See, there's a couple reasons for chop. One, because nobody gives an SHIT of what's going on because nothing's going on. It's just drifting. To me, that's less valuable. Then the other reason is there's a fight. And the fight are your best or better areas because that's where a lot of the range consolidation is going to bleed over to how I create my alert levels. And there could be some open positions there. Here's some good chop after 7 o'clock Central right in here that works as good support. Back over here, you could see the consolidation being drawn out. You could draw a line there to there. Market leaves there, comes up here, and eventually makes its way back down there. Holds the middle of that consolidation, rallies back up. You could see this consolidation right in here. Hold the top of all these bars. Bunch of 30-minute bars. That's a lot of time it holds. Then it blasts right through it. Blasts right through it, gets you bullish, comes right back down and blasts through it. If that doesn't get you bearish, what would? Right? Actually comes down in the middle of this consolidation, holds it for a half hour, few points, and then comes right back down through it. I want you to get your own levels that don't have too much complexity to it. But the notion of that's where there's open positions. The best is a decent price action day where there's a fight, and the fight during the regular trading hours. If you get a decent price action, and you got 8 points over a couple overnight session, this could be a good range. It doesn't have to be jammed up bar after bar after bar. Just get you to look back and start qualifying to yourself which areas you think are going to be good places where the market's going to stop and rotate the other way. And start working with each other to say, hey, we're testing this previous fight. Like this could be this chop right in here. Happened interday back on the 6th of May. What was it? 70, 72. If I drag this, I bet you 72 worked as support. Well, we never got back down there. 72 will probably be decent support. Now you got to use your skills when we get back down there to trade it. If you take back here, you could see this consolidation right in here. What does it do? If you draw it across, that's the top of all these candlesticks. And then what does it do when it finally gets through there? Gone. Might have been on unemployment. Was that unemployment? It's another way to take the short-term stuff I'm helping you with and apply it to the longer-term helicopter view that George is really good at. But I don't want people to just take that 3 to 5 and create a strategy from it. That's not what I'm advocating at all. Just to start to see areas where the market rested before, fought before, and come back down to that fight. Here, let me answer some questions. Where are we at now? 14.5, huh? So Jill asks a good question. How do you tell if it's a drift chop or they're fighting over it? Make a note of it when you see it. Like you get to that moment where you're trading and you're like, man, they're duking it out here. There's a line in the sand above here and a line in the sand below here, and it's like in the middle of the teeter-totter is a phrase that I'll use. There is volume coming out, and there's something going to happen. We're going to break out. Could be time of day. You could just, usually slow chop was just a 900,000 volume day, and nothing's going on. It's sleepy. Today, there was more, the range consolidations, in my opinion, would be more important because there was more fights in those chops. You'll be able to tell. It's not super objective, but you'll be able to say we're chopping around her because there's nothing going on. You'll also be able to see consolidation from a profile. See all this consolidation on 30-minute bars? Also has a big spikes in volume around 05. Could you just lay an order at 05 and risk down to 97? Good luck. That ain't going to happen. That's where profile traders have trouble. So it seems so easy, but then try to execute it. You got to have another skill to find a mini transitional moment into more of a macro transitional moment. And yes, Ernesto, these levels often are high volume areas. But that's where they're coming from. Getting people away from it looks so easy to be able to just buy the HVNs. That's what high volume nodes stand for, right? Or that's what HVN stands for, high volume nodes. But now taking those transitional moments of a long up down bar or a breakout, stop started, those things to overlap into a volume profile, level, directional level. Because now you see it's from this chop. Now you also back it up, but there was a fight there. And then you also break it down to where in the moment, in real time, are the short-term guys stuck. Because when you look at something in the past, and that's what volume profile does, all it does is look at stuff in the past. Those are guys that may or may not still be in the market. Those don't include short-term traders. It can't. Short-term traders wouldn't still be in the damn market from 2 days ago, 2 hours ago. So what's lacking is people's short-term analysis in executing a 2-hour trade, 4-point trade. That's always been lacking in the skill set in the toolbox, and it's one people never get around to learning because they don't ever. There isn't a lot of people teaching it because there isn't a lot of people that know it, and furthermore, it seems too hard for them. And so, like you've heard me say, they prefer to say, that's not my style. Okay. And as I say, it doesn't have to be your style, and oftentimes shouldn't be your style. But you should be able to read a market real time. If you can't read it, if you don't know what the short-term guys are doing, then you're not reading a market real time, is the best way I could put it. Let me go over a couple other questions. First thing I do is I look at the guy's name, and if it's Carl, Bob, or Drew, I just delete the question. Yes. So if Brian asks a good question, if you break initial support and you zip right through it, is that now potential resistance? Absolutely. That's where you got a lot of people stuck long. That's why it's a clue. When you get good levels, it's a great clue when they don't work. Because you got to switch around and you got people stuck. And if it didn't work, wow. If it's a good level and it didn't work, you should be able to create a better bias out of that. But if you have too many levels And that's another flaw of traders, is they have too many levels. If you ever buy levels from someone and they've got a lot of them, I mean, I could shake up a bunch of numbers and pull them out of a hat and compete with those levels. Pivot, 1-star, 2-star, 3-star, 4-star. There's one guy does that, and I'm like, you know what you could do with those stars, don't you? And the 3-star, oh, the 1-star worked better than the 4-star. It's crazy to qualify it that much. Shouldn't have that many levels. Yeah, so yesterday's high, if we just look at upside levels, yesterday's high was 1775, which puts us at this marker right there. And it also comes into an LVN. But remember, the LVN worked in making yesterday's high. So it's a first test of yesterday's high, the second test of the LVN. Because this one tested the LVN. If you're using yesterday's high, the next time up there's the first test to yesterday's high. If you're using the LVN, which is in here, you could say it already tested the LVN right there yesterday. That's another place volume profilers get themselves in trouble. They're not recognizing how many tests to a potential level there are. Therefore, they're qualifying it like absolute crap. They actually could have had that LVN work. Now I'll take it. Doesn't work. Yeah, Jill, if I'm understanding you correctly. So let's say a market's chopping around. Let me draw this up. So she says it's the same as if a market goes through a consolidation level, is the same of it going through a good level. So if a market's chopping sideways, rallies away from it like that and comes down and doesn't stop and just blasts right through, yeah, that's where you should, in that, let me redraw it, in that particular moment as it slides right through, pull your horns off. I mean, I understand and I like LVNs, HVNs. I mean, LVNs are great for rejection. There wasn't a lot of volume. That's where I will show you the short-term thin spots. It's the same concept of as an LVN, only it's more relevant because it's more real time, right? More real time. So HVNs are consolidation. LVNs is where tempo picks up. But you got to keep pushing yourself into real-time short-term analysis to qualify the HVNs, LVNs better. Market structure is learned wonderfully by market and volume profile teachers. You learn great theories on auction markets and just the structure of a market. But until you're able to execute the biases, until you're able to qualify which ones work and which ones don't, how not to hold on to a nice winner to a nice loser, how to manage a trade with real, you always do everything better with better real-time analysis. That's why the edge is not selling people a strategy. It's selling people a technique. It's a technique. It's not a strategy. It's not a system. They didn't teach us a system of where to buy, where to sell. They never told us not to buy or not to sell. They teach a technique, and I think that's everybody's going to apply it a little differently. And the goal is to have the deck built you know, at the end of the summer or at the end of the project. Everyone's going to build the deck slightly different, but you got a sturdy deck that people could go out on and not fall through. And just because like one time frame is bullish, they're correct. I'm bearish, I'm correct. It doesn't mean that, well, the market's going to go up in 2 hours, they say, and I think that it's going to go down over the next 20 minutes. We're both right. When you could start to line up a good long-term bias with a good short-term bias is where that overlap continues to happen. That's where you should concentrate all your energy towards in learning. Sometimes some of you guys will find order flow alone to give you good biases. Some of you guys just might learn certain instances of it to get you into a bias. You're just looking for a scenario of a big order coming in because you want to buy it anyways. Now it's giving you the timing. Well, I don't know what was up there from last week, Bruce, but the question is, if we take out this high, what would I look for? I mean, I don't know. I would look for these highs. I've got two targets at 20. Where are they? From yesterday, around 26 and around 29. These are two places people were stuck in positions. Those are going to be resistance. So that's what I would look for from last week. And then you could look at all these swing highs from late last week. Looks like Friday's high before that. Honestly, if it gets through here, I think it comes right below this swing high though, and peters off. Doesn't become bearish necessarily. But if I was long, I'd be out underneath this swing high over here, wherever that put me. And then you got to see time of day and where we're at. There's still a few hours left in the session. But you see them are struggling to get through these 14 even, 15 even area. If it lines up with good consolidation, that might qualify the level even better. Because I'm here to tell you, that's not how I create my alert levels, is from range consolidation. I don't even look back on it. But I do see it as a really good opportunity for people to start to really take not just HVNs, but understand why it's consolidation and then how to use them in a simplistic way. Not saying risk 3 to make 5, but if you did, how could you trade that better? Take the opinion out of it. You're given the opinion, now buy it. And that's an exercise I tried to work on. It's hard to do it with a group of people, because some people do it and some don't, whatever. But an exercise, those that are working hard at this, which is all you guys, is to, all right, you have to buy it. Where would you buy it? So you take the opinion. That's a good sim practice, is to say, flip a coin, it's heads. I took the work, the energy, the opinion out of it. I have to buy it. Now buy it. Now trade this bias. I'm giving you the bias. Not only buy it, not right now, you have to buy it when you want to buy it, but tell me why you bought it and why you got out. You don't have to tell me why you thought it was going up, because the coin did that. All you have to do is tell me why you bought it and what did you use to pick that location. Yes, Bruce. If these levels don't get touched, I usually leave them up there, but I'm aware of them. So we were there, I think, last week. And there were some fights up there, some open positions. Let me shrink this chart back up. So helicopter view on the left, on the ground view here on the right. If you're short on this 15 even area level that's in here, what do you need it to get through for a victory? Through these greens. They get through there, you win. If you sold it up here, you probably should be out of most of it for a small winner because it's taking too much time. It is midday though. Bulls lose through that line and it takes us back to today's or yesterday's close. I know that's not that far away, but that's short-term stuff. Sell stops right below this blue line. Buy stops right above these reds. That could take us through this consolidation top. To know what has to happen for your trade to be a winner is also important. That's where ancillary correlated markets come in because it could keep you in a trade. Get you out of one. From where, Drew? That's how I prefer guys not to call out trades, and most of you guys don't. Once in a while, I think it's all right. But nobody in the room, in this edge room, calls out their trades all day long. Once in a while, they do, and I think that's great. But nobody in here does it all the time, because you guys aren't that type of person. Once in a while, doesn't happen a lot, but once in a while, guy in trial, brand new guy in the room will try to call every one of his trades. And I know he won't stay in the room. I have a tough time calling it out as real time as I can, let alone typing it in and everything else. And I never said for him to call it, right? Nobody's ever heard me say, let me hear your trades, call them out, let me hear what you're doing. And the fact that he's telling me what he's doing shows me that he's got something to prove. Absolutely. Bruce says he sees I'm noting correlations. They're important. And easier days, it's because correlations are working better. Not yet, Ken, but welcome back. Well, when Bruce puts it, he likes when George and I talk about our ideas and walking through it, and that's what the trading room is about. That's what these classes are about, and then the team room is in addition to that. I'm going to wrap up this session. It'll be recorded and posted by tomorrow midday, so look for that. We'll stop the recording right now and wrap up with a couple other things for those listening live.